Good morning and welcome everyone to today's Protect Association webinar, where we're running through the Swiss Re 2024 Term and Health Watch report. Just a bit of a warning, you will notice that Joanna and Keith are on their mobiles. We might have had a few firewall issues on the Swiss Re side. I think we're going to be okay, but we'll see how we go. So please give us a little bit of leeway if this isn't the most professionally presented webinar that you've ever been to. I'll crack on now and we'll assume that everything's going to work okay. I'm James Edmonds. I lead the Protect Association and work across the financial services sector, helping firms meet their consumer duty responsibilities with a particular focus on customer outcomes, experience and vulnerability strategy. Great to have all of you with us today for what promises to be a fascinating and timely session. I'm going to be taking a bit more of a back seat today than usual, as we welcome two brilliant speakers from Swiss Re who will be talking us through the key insights from their 2024 edition of the flagship Term and Health Watch report. The report is always a highlight of the protection calendar, and this year's edition covers everything from market trends and sales data to the impact of consumer duty and the outlook for business protection. Our speakers today, as I introduce them, are Joanna Scott, who is the Technical and Industry Affairs Manager for Life and Health, UK and Ireland at Swiss Re. Joanna plays a pivotal role in raising Swiss Re's market profile as a technical thought leader in the UK and Ireland reinsurance space. Her responsibilities include authoring market reports, overseeing industry events, and representing Swiss Re externally on key industry topics. Joanna also leads the development of responses to government and regulatory policy changes. She joined Swiss Re in May 2022 from the Association of the British Insurers, where she was a senior policy advisor in health and protection. There she advised on a range of policy issues, including leading on such key areas as mental health and insurance. Outside of work, Jo enjoys exploring London's restaurant scene and then trying to recreate these dishes at home with varying degrees of success, and has recently adopted a kitten called Frank after Frank Lampard, which is slightly unfortunate. Keith, who is the head of Group Risk UK and Ireland at Swiss Re. Keith provides group reinsurance support, market knowledge and technical insight to Swiss Re's UK and Irish clients. He is a member of GRID's Regulations Committee and the ABI Workplace Protection Committee and the ILAG Workplace Protection Group. Bringing up 3 children and 1 dog keeps Keith busy outside of work. When pressed, he confesses to be a long-suffering West Ham supporter, which is at least better than Chelsea, a passion he's now passed on to his children, who are lucky enough to experience the roller coaster ride of the 2023 Europa Conference League final in Prague. As expected, it's mostly been downhill from the heights of the Fortuna Arena. Jo and Keith will be doing most of the presenting today, then I'll open things up for questions at the end. As always, feel free to submit your questions via the chat at any point during the LinkedIn window on the session. What I will say is also brilliant to have Swiss Re as members of the Protect Association now, and if you wanted to join to be able to get access to such experts as Joanna and Keith, then please do contact me. One last thing before we dive in, a quick thank you to Voice, our sponsors for our webinar series for this year. They help firms monitor customer outcomes through AI-powered call monitoring and QA, making consumer duty compliance more scalable and practical, and doing great things and picking up more and more clients in insurance by the day. With that, I'll hand over to Joanna and Keith.
Thanks, James. Are you able to share the slides?
I am. So hence the struggles we're having this morning. As far as things stand, I only have the PDF version. So I'll go to present that at this moment, if I can do that. Here we go.
While you're doing that, what we'll do today is we've sort of top-loaded the presentation with Group Watch, which is our first publication of the year, and then we'll pass over to Jo presenting on Term and Health Watch. Oh, that's brilliant. Thanks, James. Okay, so if we can just move on to the next slide, please.
Yeah.
That's brilliant. Okay, so just a bit of an introduction for Group Watch. Group Watch is our annual review of the group risk market. And the data included in this is in-force insurer data collected at the end of 2024. We've been doing this since about 2007, so we've spent quite a bit of time working on Group Watch, both myself and Ron Wheatcroft, my learned colleague. One of the things that, like I say, we focus on for Group Watch is data. And so the data shows us that there was another increase in group risk benefits and membership at the end of 2024. So we've got a 3.7% increase in membership across all of the three key products for group risk, which is life cover, long-term disability income, and critical illness. The long-term disability income you may have heard referred to as group income protection. One of the other things we do, apart from, in addition to the data, we collect some market opinion. So we had 42 responses to our market questionnaire, which we carried out in February this year. That 42 comprises 14 insurer responses and 28 employee benefit consultant responses. And then the final headline is that if we total all of the products together, we've got 15.7 million people covered for group risk products in the UK at the end of 2024. Okay, if we could just move on to the next slide, please, James. Okay, thank you. And the four key themes that came out of that market questionnaire at the end of February were starting off with the employer NI changes and how they will impact group risk. And so we posed the question because the NI changes were coming through a couple of months after that in April. And we just wanted to know how the market was going to cope with that. The sort of responses that we were getting was that from the EBCs and the insurers, they felt that the market would be quite robust and that it would actually impact on other things, perhaps pensions. Some of the advisors used it as thought it would be an opportunity to improve the service that they provide to their employees, trying to get more value, to their clients, trying to get more value out of their group risk products. And then one response was, I was concerned when auto enrollment was first introduced. However, that didn't impact on group risk at all. So ultimately, high level feeling, not necessarily concerned about the impact of NI. One of the other things that key themes that were coming through was the increase in added value benefits. And these are the things like digital GP, mental health support. All of these things come along with a group risk insurance product. And throughout the pandemic, these were vital for employees that weren't able to get to see their GP due to the lockdowns and everything. One of the things that's come through in the last few years have been, as we've been carrying out the report since the pandemic, is the concerns from EBCs about the duplication of cover. So if you could imagine an employer having a group life, a group CI, and a group long-term disability income product, if they're with three different insurers, they've got three lots of digital GP. And it's this duplication that we've been hearing about that causes some concern, and maybe at a time of challenges for employers with these NI changes, this duplication feels like a bit of a waste of money. So we were getting some responses on that as well, and the impact of this duplication. Also, for the first time, we were getting a lot of responses on PMI along with these added value benefits, and how perhaps the group benefits and the PMI benefits could dovetail a bit better. And then the third and fourth points that we were asking about was, if we move on to the next slide, James, so we'll just pick those up with some comments which we've pulled out of the survey that we carried out. So sick pay transparency and reporting. We asked the question, do you think that employers should be required to publish more information about their sick pay arrangements for their workforce? And these were the three of the key comments that were coming back, that there was a bit of a concern that mandated reporting could lead to more challenges for employers. They've got enough on their plate at the moment. There was also the point about what difference that would make, making employers publish what offerings they provide to their staff. What difference would it make to provision, and when you tally that up against the additional administrative complexity, perhaps just do it for the larger employers, and we're talking about the sort of responses we're getting, sort of 250 lives insured. If we just go on to the next slide, please, James. Thank you. Yeah, and so the final question that we're asking about was working with government and the Mayfield Independent Review, Keep Britain Working. This is something that Sir Charlie Mayfield's been commissioned to carry out by government. This is a non-statutory independent review, and Sir Charlie Mayfield was formerly the chair of John Lewis. So he's working on this Keep Britain Working review. A lot of the comments that we were getting were at the time that he was commencing the review, so we're good 6 months on from that now. However, the review into keeping Britain working and how employers can support employees back into the workplace when they have been absent from work, it's been well received by the industry. It's seen as a real opportunity to promote insurance as a solution to keep people healthy and keep people at work. If we could just go on to the next slide, please, James. Thank you. So moving on to the data, and this is the high level data that we collected at the end of 2024, and I mentioned that it was a good year for the group risk market, over a 3.5% increase. And if we break this down by the three products on the left, so we start off with the group long-term disability income, we've got 127,000 more people covered, and so we've got an in-force membership of almost 3.4 million people covered for the long-term disability income. We had an 8.6% increase in benefits, only a 1.7% increase in premiums, and we'll get onto that in a minute, and a 2.6% increase in policies covered. And you can see this trend of percentage increases in people from the other two products, the group life lump sum and the group critical illness, 3.6% and 4% increases in membership. So we're now up to 11.4 million people covered for the life cover, and up to 840,000 people covered for the group CI. And you can see how comparable the benefits are, increases in benefits are between the group life lump sum, 6.3% increase, and 6.2% increase in the group CI benefits, in-force benefits. So there's clearly still a lot of wage inflation coming through in 2024. We saw that coming through again in 2022, 2023. And it's probably slowing a bit now, because we were reflecting on over 10% when we were talking about this last year. Okay, if we move on to the next slide, please, James. And this is just repeating those percentage increases again for the group life lump sum death product. So you can see 3.6% increase in people, 6.3% increase in benefits, and an 8.3% increase in premiums. The disparity between premiums and benefits suggests maybe a bit of rate hardening as we've come through the pandemic. So the premiums are increasing a bit faster than the benefits. And as I mentioned, the benefit increases, that's quite significant compared to the percentage increase in people, and so suggests that we're still seeing some of that wage inflation coming through. If we could move on to the next slide, please, James. I'm conscious of time, so I won't spend a lot of time on this, but this is just some information about the two of the three group life products that are insured in the market. This is registered life and accepted life. Effectively, the registered product is written under pensions, is written under pensions legislation, and accepted is written under insurance legislation. And there are different rules that apply to both. If we move on to the next slide, please, James, we can just show the sort of proportion of members covered under each of those two. You can see a bit of a trend from these two charts here. Lives on the left, benefits on the right. The registered life is the largest group life product insured in the market. So we've got 8.75 million people covered. But it's accepted life, which is the second line down, covering 2.6 million people, that is trending up, and it's been trending up for as long as we've been recording this information. So while registered isn't decreasing, it's just decreasing as a proportion of the whole. Accepted life, because it's written outside of the pensions legislation, you don't have the same sort of restrictions that you do under the pensions legislation. So there used to be a lifetime allowance. There's still a cap on the registered life cover, and so this has made accepted life more attractive to employers. However, there are still potential issues for scheme trustees that are charged with distributing the accepted life benefit payments. Okay, if we just move on to the next slide, please, James. So moving on quickly to the group critical illness, and you can see again these percentage increases in people. 4% increase, they're up to 840,000 people. When we were doing the report last year, there was another insurer that was able to share their data. They weren't able to share their data this year. If they would have done, we think this would have been closer to 1 million people covered, about 950,000. But still a good increase for the group CI. And again, this disparity between benefits and premiums suggesting a bit of rate hardening coming through. If we move on to the next slide, please, James. Thank you. And this is just a split of the cover, the group CI market that is covered either on a voluntary or flexible product. Voluntary or flex is very popular on the group CI side. So you can see high 60%, early 70% for people, benefits and premiums for schemes that offer either employees the option to join or not join the scheme, or there's fewer of these, but flex schemes where the employer provides a core benefit, say 2 times salary, and the employees have the option to flex up from that. But the voluntary and flex works very, very well on the group CI side. There's no upfront underwriting. Everything's covered under a pre-existing condition exclusion. If we were looking at the voluntary or flex split, really the flex split for life and IP, that would be either 15% for IP or 20% for group life, so much lower. If we move on to the next slide, please, James. Brilliant, thanks. These are the increases in group long-term disability income, the IP side, and again we've got this 4% increase in people, so up to 3.4, almost 3.4 million people covered in the UK for the IP side, group IP side. We've got this disparity between benefits and premiums, so benefits going up 8.6%, premiums 1.7%. In part, we think this is due to the increasing interest rates that started happening in 2022, came through in 23. A lot of these schemes that we're reporting on in 2024 will have been costed before those changes in interest rates, and so when they were costed at their 2-year rate review point in 2024, the impact is a reducing premium. We've also got this ongoing transition of cover from limited payment term, from cover to retirement to limited payment term. That's on the next slide. So if we just move on to the next slide, please, James. So this is the research. We've been doing this since about 2011, and this is a split of cover period across scheme categories. And if we look at the top right pie chart, you can see that in 2011, almost 75% of schemes offered cover to retirement. So effectively, if you were unable to carry out your job due to illness or disability, you could be covered up until your retirement age. And you can see this transition as we go through 2018 with the cover to retirement reducing and the limited payment term coverages getting larger. And here we are now in 2024, and we've got 39% of people covered to retirement, 37.5% of people covered on a 5-year limited payment term, and then the balance, around 23%, covered on shorter limited payment terms, and those are 3 years or 2 years. So this is something that's been happening for a long time now, and it's not necessarily that schemes suddenly change to a 5-year limited payment term or a shorter one. It is a significant cost saving for the employer. What we think's been happening is that categories have been closing. So members that are covered to retirement in a closed category, open new people that join the company, join the limited payment term category. And what happens is, as a part of reporting, a scheme moves across to being reported as a limited payment term one when that limited payment term category gets bigger than the retirement category. It's probably that. It's a very difficult sell to the employee if the alternate happens and the scheme just moves from retirement to limited payment term. It's a tough conversation to have with employees. My final slides is just the next slide, please, James. And we don't have to spend a lot of time on this, I'm conscious of time, but this is some analysis that we've been doing for a few years now. This is a scheme size split, and this is something that came about when Ron was talking to some DWP officials, and they challenged Swiss Re to provide some evidence or data of to disprove the sort of assumption that the group long-term disability income market is only interested in large employers. So we started asking for this in about 2015, 2016. You can see from this that in terms of scheme numbers, the majority of them are for what you would call small or medium employers, and it's really only 10% that are for those that are above that 250 life point. What we can't cut down into is how many schemes are just insuring the top lives in that company, maybe the directors, but when we talk to insurers about this, the general assumption is that's not the case. And then on the equivalent side, obviously these larger schemes employ more people, and therefore their total benefits are much higher for that scheme. So you've got this opposite on the right hand side where you've got 65% of enforced benefits covered for schemes with 500 or more lives, and over 70% for those with more than 250 lives. That's my last slide on the Group Watch side, so I'd like to hand over to Jo to go through Term and Health Watch.
Thanks, Keith. And it's really helpful to hear the group numbers first, just to get that kind of whole picture of the protection market, because it's quite hard to view them all in isolation. But yeah, just coming on to the individual numbers that we reported in Term and Health Watch this year, you'll see on this slide that in 2024, so obviously we report on the previous year's data, we reported that just over 2.04 million new term assurance, whole life, critical illness and income protection policies were sold. That was an increase of 2.2% compared to 2023, where in the past couple of years we had quite kind of a tough experience with new business in the protection market, just with the cost of living crisis and things like that, which we'll delve into in a bit more detail. But you'll see in the bullets below that not all of the products fared equally. And again, we'll break down the term numbers in a bit more detail, because obviously there's some quite different products behind that kind of overall term label. But you'll see that, so there's a percentage change on the left, and then the policy count change, negative or positive, on the right. So you'll really see here that the positive increases were really kind of seen in the standalone critical illness market and the income protection market, where we saw some really healthy percentage increases. But interestingly, I think when you look at it on the right hand side, so look at the pie chart, as a proportion, even though we see those kind of really big percentage changes for standalone CI and IP, there's still a relatively small part of the whole market. So I think it's 11% and 7% overall. And the kind of term only market is still the highest proportion of policy sales, where we see it's 50%. I think it was 51% in 2023. But yeah, just interesting to see that whole breakdown. And yeah, you can see in the whole of life market. So we did see a slight drop in the guaranteed acceptance whole of life market. We might expect that to drop again this year, just with the increased focus from the FCA's market study, and a slight drop in the underwritten whole of life market. But we did see premiums go up. So as we'd expect with the changes to inheritance tax, we'd expect this to go up a little bit, but as premiums were still going up, which is positive. And if we just go into the next slide, before we look at some of the numbers in a bit more detail, these are just some of the topics that are kind of flying around the market. Obviously, it's been a really busy year, or couple of years in terms of regulation and focus from the FCA on the protection market, and kind of leaning into that, kind of looking at increased quality. And then there's obviously been a lot of tech changes as well, and kind of consumers' attitudes towards technology, and kind of, as Keith hinted at a bit, with the government policy changes, and particularly the ones that impact the individual protection market, is probably kind of IHT, like I mentioned, and other things like that. So it's been a really kind of a pressurized market, I'd say. So it's kind of really good to see that we've had some positive changes in the last year. So if we just go into the term and CI numbers in a bit more detail on the next slides. So this just shows the data kind of going back the last 5 years. I do think we have the data going back into the early 2000s or even the 90s that Ron's got stashed away somewhere. But this, I think, really helpfully shows how we did have that kind of peak after the 2020 pandemic, where the delays to medical evidence and things like that kind of eased a bit. So we had a bit of a surge in the term and term with CI sales. And it's been quite a tough couple of years since, as I mentioned, with the cost of living crisis and kind of increased pressure on consumer and household spending, with kind of increased inflation and things like that. So while we saw kind of just a slight decrease, so by 0.8%, I think that's still like pretty positive given the tough couple of years that we've seen, and that's the lowest since 2016 is the data that we've seen there. And then if we just go into the next slide, is looking at the CI numbers in a bit more detail. So this is the same divide, but looking at kind of term with CI, whole of life with CI, which is a really small kind of niche provider product, and then the standalone CI there. So as I've mentioned, we've seen like a hefty amount of growth in the standalone CI market. I think even in 2019 it was kind of 60,000 odd, so it's kind of over doubled in the last 6 years, which is pretty impressive. We'd expect that to be linked to kind of the growth in multi-benefit policies and just kind of the focus on possibly how insurers are categorizing it, because we only see the data at the year end, and kind of how providers categorize it might be they might be separating it out between life and CI. But this meant that we did see in the CI market only a 2.5% increase, which was really good to see. And if we just go into the next slide, this breaks down the term assurance numbers in a bit more detail. So as I mentioned earlier, we did see a bit of a kind of different picture with some of the different term policies. We've got level term, decreasing term, then with and without CI, standalone, relevant life, and family income benefit. So you'll see here the real kind of winners for the term assurance sales were kind of decreasing term, which was really positive to see, because we saw kind of a pickup in the housing market in 2024 after kind of a kind of rough couple of years with increasing interest rates and things like that. So it was really positive to see kind of growth in the DTA market. The term with CI has had a bit more of a kind of tougher couple of years. We think possibly due to affordability, where customers, when we look at the next slide, it will show the average premiums, where there's still kind of quite an increased cost on customers. Thanks, James. So yeah, if you look at the bottom table, if you compare the like DTA with CI, which is the average premium is £684 for the year, whereas the DTA is £285. So I think even with that uncertainty that customers are having with the economy and the government changes and things like that, you might expect that people would still lean towards maybe getting some form of protection, but maybe not kind of the whole suite of products. But yeah, it's been a really interesting couple of years, and we'd hope to see kind of, I think early data that we've seen into this year has been a bit more positive. but we'll see how it goes until the end of the year. And the final thing to mention on this side maybe is that despite the kind of growth in standalone CI, it's the only product that we've seen that has decreased in the average sums assured and average premium. And that again might link to people getting maybe like a smaller amount of standalone CI on the side when they take out their term policy. Interesting, when we looked through some of the PCWs, I think it was one of them, I can't remember which, suggests that customers take out 45 grand worth of standalone CI, and that's kind of just below what our average sums assured is. So maybe there's some kind of consumer behaviours there that are mirroring those nudges, which is interesting to track. And if we just go into the next slide, I know it's quite a busy slide, so we will send these after, just if you want to unpick this in a bit more detail. But this shows the distribution splits, and we'll look at the non-advised and advised splits in the next slide. But kind of in summary, you'll see that we've divided out the distribution between aggregator sites, IFA networks, execution only, tied, direct, and bancassurance. So for all the products, so we group aggregator, IFA, and execution only as directly authorised. So for all the products, you'll see that that is the main kind of sales channel across all of the different product lines. For standalone CI, it's kind of just about. But with standalone CI, we've seen a growth in tied sales, particularly from growth in one provider, which is quite interesting to see, and quite a lot of direct sales there as well. But overall, we did see an increase in IFA network, but a decrease in direct and bancassurance. And I'd maybe point out here that our data may downplay the role of an aggregator, just because wherever the sale is then passed on to an IFA or a network, we get the data where the sales concluded. So even if the sales journey might start through a price comparison website or an aggregator site, it would most likely be grouped under IFA network for us. And if we just go on to the next slide. So this slide actually shows the non-advised sales. So if we look on the left, we've broken it down between level term and decreasing term. We've got all of the breakdown in the report as well for the different product lines. So if that's of interest, we can definitely share a bit more detail after this meeting. But the interesting things to point out, I think, on the level term especially, is even looking back to 2021, Swiss Re reported over 50% of all level term policies were sold through non-advised channels. As you can see, that's a completely different picture now, so it's down to 33%. That, we think, is kind of over the past few years, probably the changes to kind of lead generation and possibly kind of firms switching to more advised channels, or a few firms kind of leaving the market. But there's been kind of a bit of an impact here, and a sustained drop in sales that are non-advised. It'd be interesting to see if that market picks up again. I'm not sure, to be honest. It might be a bit harder with the increased regulatory focus here. So it'd be interesting to see. And on the right-hand side, you can also see that despite an increase in DTA sales, non-advised sales as a proportion of that fell again. So yeah, it's a super interesting market we'd expect to see. And if we just go into the next slide, we've got the gender splits for terms. We've got the level term with and without CI on the left, and decreasing term with and without CI on the right. And again, quite a busy slide, so I'll just point out a couple of things here. Is that across all 4 product lines, we saw a decrease in joint life sales. That has been a pattern over the last couple of years, but perhaps might have been impacted by the industry kind of narrative on single is best. But as I mentioned, it kind of has been a pattern over the last few years, and we're kind of agnostic on that, but just kind of interesting to see the trends. I'd also point out on the level term on the left-hand side, you can see that we've got the darker shade as male at the bottom, then female, then joint life. So for LTA, we do tend to see more females taking out cover, which is really positive, but I would also say that there's still quite a big coverage gap. So the average new sum assured for a level term policy for males is 24% higher than the benefit purchased by females, and the premium is 25% higher. So there's still kind of quite a big gap in terms of the coverage that females are getting, which is something we want to look at in a bit more detail, and whether it links to kind of gender pay gaps and things like that. Obviously, I think the gaps are slightly smaller on the DTA side, given that you're kind of covering a mortgage, which hopefully wouldn't be too much different. But there still is a gap, which again is something we would want to try and unpick a bit more. And then just going on to the next slide. So this slide shows the business protection sales in 2024 and kind of going back to 2019. And I show the 2019 numbers especially just because this market was particularly impacted by the pandemic. As you can see, sales dropped kind of over half, and it's kind of really struggled to get back to the 2019 sales. So you can see the level term with CI, key personal IP. And for the first time last year, we started collecting the numbers on executive IP, just to try and give a whole kind of picture of the cover that's available to small businesses. Obviously, it kind of sits somewhere between the individual and the group market, but just kind of interesting to see that all of those sales. As Swiss Re, we view this market as kind of really positive, and like obviously it's really high value. You can see on the right hand side that the sums assured are particularly high, so kind of for LTA it's over 700,000. However, you can see that there's a bit of more of a gender skew towards males, so over 80% of all level term policies were sold to men in 2024, and that was 81% in 2023. So again, we've been doing a bit of work in this space, and that we'd like to share more of. This year, we've done an advisor survey, kind of looking at how we can, what are some of the barriers towards selling business protection, and we've been supportive of an initiative led by Stuart Halliwell, kind of on Business Protection Awareness Week. But yeah, so if anyone would like to speak about business protection in more detail, we're obviously very happy to, and we've got a lot of kind of market data on this. And then just going to the next section, so looking at income protection in a bit more detail. So obviously IP has been kind of the star product, I'd say, in the last couple of years, and you can really see here that there's been some really positive growth over the last couple of years. Obviously in 2020 this market struggled a bit with some of the shorter deferred period products being pulled temporarily, but we've seen this kind of really healthy growth. And interestingly here, so you can see on the chart on the top, in 2022 and 2023, we saw a real shift towards the limited payment term products. So that's the lighter shade at the top. And that's perhaps due to affordability, just with the cost of living crisis and things like that, where those products are a bit more affordable. But in 2024, we saw that shift kind of going back to roughly 50-50, which is positive because there's been some kind of talk in the market over whether customers were adequately protected if they took out a limited payment term policy. Obviously it does suit some customers' needs, but kind of what happens at the end of the 2 or the 5 year payment period if they're not back at work. But you can see kind of on the chart below some good healthy growth across all of the product lines apart from the 5 year, in contrast to the group market where 5 years is kind of more standard, which is interesting. And then if we just go into the next slide, looking at the average premiums. So this also could factor into why we've seen the more normal retirement age products, so the full benefit or full term IP, is that average premiums have slightly dropped, whereas average premiums for the 2 year limited payment term products have slightly risen. So perhaps if you're kind of tossing up between the products and kind of there's less of a gap between, obviously there still is quite a big gap, but if you're thinking about kind of your long-term protection, perhaps people are kind of thinking they'd rather take out the normal retirement age product. Obviously that's kind of where the advisor is really crucial in those conversations. But yeah, the benefits have been good to see. And if we just go into the next slide, where we've compared the average benefits for the normal retirement age product and the limited payment term product and overlaid that with national UK earnings, and then we've done a proxy of 70%. which is obviously a bit high in terms of what you would get from an IP policy, but it's just kind of a rough proxy just to see if IP benefits are keeping up with national average earnings. And you'll see here that roughly the normal retirement age product does kind of stay in line with average earnings, whereas the LPT2 product is slightly below. And whether that's just the consumer demographic of people taking out an LPT2 product, or if people are taking out kind of just to cover their basic bills and mortgage and things like that for a couple of years, could be that. But it's interesting to see that it does track. I'm going to adjust it for inflation again. It kind of IP benefits remain kind of in line with wage growth, which is obviously positive to see. And then if we just go on to the next slide. So with IP, our distribution splits is kind of slightly less exciting, where we see the majority of sales are through those directly authorised channels. We've had some feedback this year to see if we can break that down in a bit more detail like we do with the term and CI market, so it's something we'll look at. But as you can see, the majority of the growth came from directly authorised sales, a little bit from Tide. However, the direct and bank assurance markets also drop, similar to the term and CI market. We do collect the non-advised sales for IP, but they remain pretty low, so 7%, and it's kind of roughly 7 or 8% every year. Obviously, we're aware that some providers have tried to make a non-advised IP policy work, but haven't really seen any kind of break through that just to kind of get above the 7 or 8% mark. And I think there's some big divisions in the industry of whether IP should or should not be sold non-advised, but maybe one for the questions. And then just going on to the next slide where we have the gender splits. So for IP, the gender splits do remain roughly kind of 60-40, where you can see a slight shift towards more female lives than the last few years, whereas so it's 43% to 57%, but roughly it doesn't change a huge amount year on year. However, interestingly, the average benefits is where we saw a bit of a shake-up from 2023 to 2024. So in 2023, we reported that the average benefit for females actually surpassed the average benefit for males, which was the first time that had happened. Whereas in 2024, that's kind of shifted again. So the average benefit for males actually increased 7.6%, and the average benefit for females decreased by kind of almost the same. Whether that's kind of, and the premiums both decreased kind of in line with what we mentioned before. Not really sure kind of what's behind that. Maybe just females taking out a bit less cover. Be interesting to see if that trend continues into 2025. But yeah, we'll keep an eye on that one. And just coming on to the last section on whole of life. So I mentioned it slightly, kind of a little bit at the top end of the presentation. But if we just look at the top chart, looking at the guaranteed acceptance whole of life sales, so that's kind of the over 50s products where they're sold predominantly direct. But we did see, as you can see, kind of 2021 to 2022, there was a pretty big drop in this market. A few things behind that, like a couple of providers exited the market, and also there was kind of a bit more strain on some of the like marketing budgets across the market, and these products are largely sold direct to customers through kind of TV advertising and other routes. So there's been kind of a slight increase in 2023 and a slight decrease in 2024. Obviously, as I mentioned, these products were kind of referenced in the FCA's Pure Protection Market Study. So it'd be interesting to see if that kind of impacts sales in 2025. Yet to kind of look at that and market in a bit more detail. And then looking at the underwritten whole of life numbers below. So as I mentioned before, we did see a slight drop in the underwritten whole of life numbers, but an increase in the premiums. But we have seen some healthy growth in the market, as you can see from 2020 to 2024. It's still kind of a considerable amount of growth, even if we saw a slight drop in terms of policy sales. I'd expect that to kind of grow in 2025 just with the changes to IHT, but again, be interesting to see. We've heard anecdotally from some providers and advisors that there's a lot of interest from customers in these products, as you'd expect, with people kind of looking at their estate planning and things like that. So that brings me to a close. I don't know if there are any questions, but thank you very much for listening. We could obviously share these slides as well, and if anyone would like a copy of the reports, we're obviously very happy to share those as well.
Yeah, any questions at all, just email them across.
Yeah.
It says that I see a comment here, James, we can't hear you.
Ah. Oh, here we go.
Okay, can you hear me now?
Ah,
yes.
Yes.
Excellent. Okay, no worries. I've just been talking away to myself. So I was just going to ask a question. As I say, we've had a couple of bits through in the chat we'll go into in a moment. Joanna, with your background, ABI and Swiss Re, how would you describe the industry's progress in adapting to Consumer Duty? Something I work on a lot, especially when it comes to vulnerable customers and mental health.
Yeah, definitely. I mean, it's a huge topic, isn't it? And I think as reinsurers we're probably one step away, but it does mean we get to see kind of the whole market picture. And I do think that firms have taken the Consumer Duty requirements very seriously. Obviously, there's a lot that they've had to do, kind of not even just in protection, but across the general insurance and investments and things like that. And I think it's kind of a work in progress. But what I've always enjoyed from working in the protection market is that by our nature, we work with customers who are kind of most likely vulnerable. So perhaps we're a few steps ahead than some other product lines. Obviously, it's never saying that it's complete, and there are obviously still kind of areas to work on, as highlighted by the FCA's kind of work looking into bereavement claims payment times last year, and also the launch of the Pure Protection Market Study. But I think from what I've seen, the industry are coming at it from a really collaborative approach and kind of a willingness to look at things that maybe are working well and not so well. And I do also think the regulators look at it from a really collaborative approach. So I think if there's areas that maybe are not working well, I think everyone's kind of open ears and willing to change. Is my personal view.
Sure, and that's good to hear. I think certainly from a macro level, I'd agree with that. And individual conversations with clients, sometimes it's hard to see the progress, but I think when you do take a step back and begin to recognise what some organisations are doing, and indeed what I would perceive to be generally improving customer outcomes, that's good to see. Keith, anything to add from your perspective?
No, I think Joe's covered it perfectly there.
Sure. Okay, so I have got a question for you as well, Keith. So given, I suppose, what you could call the persistent underuse of business protection, despite the rising interest in income protection, what do you think is holding advisors back? Is it awareness, complexity, or something else altogether?
I might hand that one across to Joe, because that business protection falls more within your remit.
Definitely. So again, I can't really speak for advisors, but we've spoken to a lot of advisors in the last year or so looking at business protection. I would say it could be a confidence thing. Obviously, there's a lot of training provided by insurers, but I guess for some, it's obviously, I think those who are experts in the market are full kind of experts, and they live and breathe it, and they're very successful about what they do. But maybe those who kind of fall a bit in the middle, maybe, and I guess with businesses it's slightly different and perhaps more complex with the tax and things like that. But I do think maybe similar to what happened with income protection a couple of years ago with the drive to kind of advisor awareness with income protection awareness weeks and things like that from the IPTF. There's maybe going to be more of a shift looking at business protection and maybe giving people some of the tools and the awareness to kind of help maybe even have the conversation, because I think the amount of times people will be speaking to a customer, if they have a business, it's kind of probably worth speaking to them about that as well. And that could all kind of fall under the consumer duty as well of kind of consumer needs and things like that. But yeah.
Lovely, thank you, Joanna. And then we haven't had any direct questions come through, but just one LinkedIn user. Good insight here. Would love to dig into claims and the claims data, e.g. length of claims and the factors affecting those. Is there anything worth bringing up there, or?
We probably, again, it's probably more for the insurers. We see it kind of all a bit of a step back. I don't know what your views are, Keith.
Yeah, GRID, so the Group Risk Industry Trade Body, Trade Association, GRID, does carry out an annual study on claims, and that's something that you might see in the trade press. That came out about 2 months ago, about June time. So there is an annual study of the group risk claims market, and that breaks it down by numbers of claims. I can't remember if it breaks it down by period of claim, but it does break it down by condition.
Right. Excellent. Okay, thank you, Keith. So no more questions as far as I can see. As Joe mentioned, we'll be able to share a copy of the slides after this session. So that's great, and I hope you all are able to have time to go through those and let us know if you do have any questions. So yeah, thanks to Joanna and Keith for their insight and experience today, and thank you obviously to everyone else for joining us as well. Before we wrap up, a reminder to visit the Protect Association website, where you'll be able to find this and all of our other previous webinar recordings. Thanks again to Voice for sponsoring this session and supporting Protect through 2025. And if you're not a member of Protect or would like to have a chat about getting involved, just drop me a message on my LinkedIn or over email. So thanks again, and we'll see you next time.
Thank you.